Welcome back to part 2 of our series here with Stephanie Link. This week we're going to dive deeper into her role at Hightower, her fund, and how she approaches investing on behalf of clients. Well, I'd say welcome back for everyone watching. It's been a week for you and I. It's been about 30 seconds of some bad stories on my part. So you have many, many roles. And the first one, we covered your background, come from a family who's been around investing. You can tell it's a deep, deep passion of yours. The Chief Investment Strategist of Hightower. We'll get maybe into these in weeks 3 or 4. You're a mom. You're frequently on CNBC. You're also a fund manager, specifically running a basket of securities. So let's go there. Let's talk about your fund, your approach to investing. What do you bring that you think is a little bit different than maybe some other people's approaches?
Sure. So when I decided to come to Hightower, one of the agreements that Bob Oros, our CEO, and I had come to agree on was that I would run money because I want to have skin in the game for a lot of reasons. A, I'm passionate about it. I enjoy it. It's very humbling, but I like to learn something new every day. When I worked with Jim, the style that I chose, which is a very concentrated portfolio, was at large cap core, which is a combination of growth and value. That started when I worked with Jim for 7 years. And then I went to Nuveen for 5 and did the same thing. Always concentration to me. And now here, I have about 30 to 40 stocks in my portfolio. I mentioned large cap core. I chose to be a large cap core manager because I want to decide what style makes sense at the time where I can make the most money for myself and for my clients.
Value stocks versus growth stocks.
Exactly.
Maybe since I've got you here, because I'm always like, well, how do I explain? I certainly have some clients say, well, I don't want the value stocks. I want the stocks that are going to grow. So give me the growth stocks. Maybe quickly explain to people what is a value stock, what is a growth stock, and how they, to your point, both can go up.
Right. I mean, it goes back to, are you looking for fast growth companies, low dividends, maybe some buybacks, quality companies more on the momentum side, where earnings revisions on the way up and on the way down are really very, very important. They tend to be more expensive. And value stocks are trading at a discount to their intrinsic value. There's many ways of looking at valuation, but it's very valuation centric, things that are maybe more contrarian. And so for me, the reason I chose to be both is because I can tweak it. And I do tweak it based on kind of what I view as big picture. I start with the macro in terms of my portfolio.
I love this. We talked about it a little bit. So I mean, I hate to interrupt, but I do love this story of the macro, the sector, the stock. So please walk us through that.
Yeah. So I love to think I could talk macro all day long. It helps to just give me the framework of where are we in like the business cycle, in the economy, here, around the world. What's the Fed doing? Where are interest rates? That helps for me to decide where I want to have exposure around the world. We were talking about how I am mainly a U.S.-centric portfolio manager, so U.S. companies. But U.S. companies, there are a lot of them that are multinational, right? We have, in the S&P 500, 60% of the company's revenues are overseas. So I look and identify where I want to be in the world. And then I based on that, I look at sectors where I want to be. Do I want to be overweight technology? Do I want to be underweight energy or overweight financials? The S&P 500 has sectors and they have their own weighting, and that's my benchmark. That's what I'm marked to every day. If I beat the S&P, I'm a winner. And if I don't, I'm not so much a winner. Hopefully we don't have too many of those. But it really depends on how you weight the various different components. And then once I figure out where I want to be in terms of sectors and that sort of thing, then I do the fun stuff. Then I do the fundamental analysis. So I look at like the number 1 or number 2 company in any given industry, and I will always go with the number 1 or number 2. I tried very hard to convince Jim Cramer many years ago to go with number 3 and number 4. And he used to say, they're number 3 and number 4 for a reason. And it's usually the case, right?
And if I can back you up just because I love, again, a lot of what you bring to how you do pick stocks. But you were saying your macro informs almost a sector budget. So you have some idea based off those macro trends that you're seeing that you want to put X% into that sector and then you go about looking for who should get those dollars.
Exactly. And then what they call fundamental bottoms-up analysis, and that is, again, looking at various different companies, number one or number two, looking at balance sheets, looking at free cash flow, looking at margin opportunity. And what I'm very focused on, two things. One is where those stocks are they underappreciated by the marketplace? Are they cheap for a reason? And number two, that leads me into, I won't put any stock into my portfolio unless I have met the CEO and the bench. And maybe just by virtue of being old, I know many CEOs. That also is a help on TV as well. We know that the CEOs like to watch when we're on TV, criticizing or complimenting, depends. So that's how I start the whole process. And then valuation is really very important to me. I am looking for kind of growth at a reasonable price, which is called GARP, and hopefully there's a catalyst, because a stock can stay cheap for a really long time.
We'll talk about, try to explain again things that make perfect sense unless you're speaking about it in market terms. And one of those things being, again, valuation isn't the catalyst, right? So you can have something set up, talk about gasoline on the floor, you still have got to get that match to get that fire going.
Right, and the management teams are so incredibly important, just given their track record, right? If a stock is on sale, right, it's down for whatever reason, why is it down, and can they fix it? And does the CEO and the team, do they have a proven track record to fix it? And what is that time frame? It could be years, or it could be months. So I try not to be too short term and have patience, but again, we try to beat the benchmark. One
thing I definitely want people to hear from you who aren't going to be able to make tonight's event is still being an active stock picker. I think a lot of people have given that up for dead. It's become a very passive world. Again, we were talking about this earlier, just how much fewer publicly traded companies there are, how that could have been a catalyst for helping passive, but how we might be, not that what you've been doing hasn't been important, but really entering into a day and age where active stock picking, a quality manager looking over that basket of stocks is going to matter a lot again. Can you speak to some of the different trends you see in that, and I guess justify why you do what you do in a world that has, again, become so passive dominant?
Okay, at the end of the day, the long-term history of the S&P 500, this is a 50-year time frame, is 7.7% on average, total return. And fixed income, it's 3%. So my goal is to actually, A, lose less money, what they call downside capture. You go down less than the market. Yeah. And on good years, hopefully I can outperform. But if I don't feel so bad if I've helped on the protection side. So I have to think about all of these various different things that, guess what? If you're passive, if you're owning an ETF, you could be down 2 years ago, down 18% in the S&P 500. And actually, I was down a whole heck of a lot less. And by the way, the NASDAQ 2 years ago was down 30%. Now, I know we had a great year last year, and it felt much better. And even to date, we're feeling a little bit better. However, I still come back to, may have fits and starts of concentration in the Mag 7 or the top 10 companies in the S&P 500, which, by the way, year to date have accounted for 70% of the returns. That's not normal. Right. At some point, that's going to unwind, and it may not be a bad unwind. It may just be they sit and settle down for a little bit, but maybe you have participation in the other 493 companies that are cheap, that might have catalysts, really well companies, and you have opportunity. And I come back to diversifying. You practice this all the time. I'm certain that is a very big conversation point with your clients.
It's a harder conversation when you have 5 stocks dominating the world, but it's still important.
I know it's tough, and it feels great when you get 1 or 2 of these high flyers right. Okay, but it could also reverse pretty quickly. We were talking about one of the most popular companies. I'm not going to mention any names.
We're gonna save compliance.
We got to save compliance. Yeah. But one high flyer could be up 150% year to date, turns around in a week and a half, it's down 15%.
More often than not, we'll talk about, hey, if you're down 50, you got to be up 100.
Right.
Much more, obviously, facetious. I would tell people, you could be up 1 trillion%. and then you're down 100% and you have zero, you have nothing left, right? I mean, downside is powerful. And there's even a lot, when you look at historical averages, that kind of mask, again, some of the real damage, carnage, let alone unexpected life events for this money that you need. Sure. It's not just a theoretical exercise. We're interfacing with lives that have their own uncertainties.
And to your point,
that make an even bigger deal out of a downside protection.
Of course. And those, when the NASDAQ was down 30% in 2022, a lot of those stocks never came. They're still not back. So maybe the Mag 7, they're back. They're more than back. That's great. But there's a lot that's not. So that's why I think having someone that can protect on the downside, hopefully get you the appreciation on the upside, and is thoughtful about what I own. Like I own quality, and I'm trying to find bargains.
Yep.
And I think that's fun, and it has, over the long term, it's actually done quite well relative to the bet.
We love what you're doing for our clients. We're going to use this to jump into part 3, which is just kind of general lessons for investing. You won't want to miss it. Thanks as always for joining.